Welcome back. We're continuing on topic 2. I'm always really hopeful that topics will fit neatly in today's, but they won't, but that's okay. We will be fine. Before we start, any questions, concerns, frustrations, anything you want to focus on more or move faster through? Okay, I'm trusting you all to basically call out and have a conversation. So, come on, there we go. I wanted to just really continue on with some of this company law refresher stuff that we were finishing and just make a few really, in some ways, kind of obvious points, but points that we'll need to keep coming back to just to frame the kind of transactions we're dealing with. Any legal person can own a company, or any legal personality. And so as we started to talk about yesterday when we were doing the quiz, companies can own companies. Proprietary limited companies can own public companies or shares in public companies. In fact, a proprietary limited company might be the sole shareholder of a public company. There's absolutely nothing to stop that from happening. A public company can own a private company or a proprietary limited company. Individuals can hold shares directly. Trustees can hold shares for the benefit of trusts. Shareholders can be traced backwards in a number of different ways, and particularly as we go from, and we're going to follow this idea of M&A transactions through kind of the potential life cycle of a company, starting with a small company and then basically evolving, getting bigger, listing on a stock exchange, which is where we'll take it to this afternoon after we do some private equity transactions over the course of the morning. And then the next time we meet, that company might buy or sell some businesses, or do both, buy a subsidiary, sell a business, something like that, and then to the point where ultimately it either seeks to take something else over or gets taken over on a stock exchange. And so working out actually who the stakeholders are and who the shareholders are can be really important. As we mentioned yesterday, the general rule is a company can't hold shares in itself. So as shares can be sent every which way when you think about it, particularly public company shares where the directors have no ability to stop a transfer as a matter of corporations law anyway, the directors may have that contractual right under a shareholders agreement of some sort. You can end up with, like, this looks beautiful on the slide here. You know, it's very neat. We can see it's actually usually drawn by the way going down, shareholders at the top, sort of moving down to where the company is, but it just didn't work nicely on the slide to do it that way, and smart art isn't actually that smart, as it turns out. It's just not. So it looks very neat, though we can see the flow down. But when you look at a complex corporate structure, it's not at all unusual to see companies having various interests in each other, directly or indirectly in different groups, and a small change in the ownership of one company could end up with indirect changes up the chain that impact that rule that companies can't have ultimately ownership in themselves. So I think some of the terminology, this cold is really getting to me, I think. I don't know what's happening, whether I'm literally getting Alzheimer's, you saw it here first, folks, or whether it's the flu. But the number of times that I've used the wrong word in the last 24 hours is just embarrassing. So terminology. A subsidiary might be wholly owned or might be partly owned, but a subsidiary is a company or an entity, let's call it a body corporate for want of precision, that has a parent company. So a parent company owns a subsidiary company. It might not own all of it, Again, depending on which set of rules we're looking at, in order to be, often the question is whether it controls, a company controls a subsidiary or not, but the language we use is subsidiary. We talk about wholly owned subsidiaries. Sometimes subsidiaries are created for the purpose of making investments. Sometimes they are incorporated for the purpose of operating businesses. It doesn't actually change the nature of what the company is, its legal structure, but it can change the way that it is treated in a group. So I've had, so what I've tried to do there is look at, what have I tried to do there? Why have I got that link between an investment entity and a wholly owned subsidiary of a separate company? No notes to help me out there either. I think that line shouldn't be there. What I'm trying to do, I just want to eradicate this line here. Let me just take it out. Oh, get so fancy, and then I forgot to hit that line shouldn't be there. I have no idea why I put it in. We're starting off well, folks, aren't we? So basically, if we look at this we can classify as a group. Now, sometimes corporate groups will elect to be a group for tax purposes. For our purposes at the moment, unless we're specifically talking about a group for tax purposes, a tax group, where in a nutshell, that is an election that related companies can make so that they effectively have a treasury entity, so an entity that pays the bills, deals with all of the money, and that they submit one tax return. Again, I've got Carly just sitting here, and I know I am massively oversimplifying how that works, but we're basically, so if we think about, stuff in the news all the time about big corporations that don't pay tax at all. So when they talk about Google not paying tax, actually, if you drill that down legally, what they're talking about is the Alphabet Group, which is a parent company that is listed on a stock exchange that owns many, many subsidiary companies. So let's call that Alphabet. Alphabet makes sense if I do it this way. We've got many subsidiaries that sit under here. They might include the search business, they might include their GPS business, their robots, all the deep mind, all the AI stuff they're doing, their advertising business, all the rest of it. It's going to be a much more complex kind of structure than I'm showing you because, again, there'll be, for each of these businesses, there's likely to be subsidiary entities in the different countries that they operate in. So down the bottom, some of these entities will make money. That money will then be spent. Some of it will be spent on getting license fees from entities higher up in the chain. Some of it will be spent on employees in the country. It'll be spent on all sorts of different things. But at the end of the day, they will weigh up, in theory at least, what did I spend versus what did I keep. The amount that they keep, we can roughly call that profit for the sake of just upsetting all of the accountants in the room. So, and ultimately that is the income or the profit, roughly speaking, that they would pay tax on. But by consolidating as a group, then they do that ultimate equation at that one end, at one entity level. And then they pay their tax or not pay it at a particular level. So they group so they can offset losses in one company against profits in another company. And then when you add in different jurisdictions, you end up with different end results. Gee, that's really, really clear now as I can see it on the screen. Hopefully it helped as I was talking it through. So any questions, concerns there? So thinking about a tax group is one thing, but thinking about an ownership group is really what I think is important here. Let me just get rid of this. So when we're thinking about transactions here, let's get rid of that line because we don't need it. When we're thinking about transactions here, we have got a listed company here. Oh, Cathryn, really? A listed company here. This is where the shareholders sit. So they might be superannuation funds, they might be investment banks, they might be brokerage houses, they might be competitors of the company. They can be anybody who has basically fronted up and bought shares in a particular company. These people tend to think, I own a bit of, I'm using Google as my example, I own a bit of Google. So this wholly owned subsidiary that's here in Australia, they have an indirect interest in that, but they are actually shareholders of this company. And again, Google is a bad example because it's an American company. The rules may well work quite differently there. But if let's use Wesfarmers as an example instead, where it is known for having lots of different subsidiaries that do lots of different things, even though your owner might think, shareholder might think, oh, well, I've got a little bit of Bunnings Warehouse or Office Works or whatever it is that's in that group. Still can't remember off the top of my head. In fact, there will be a chain of subsidiaries, and the subsidiaries themselves, as we were talking about yesterday, and at least in theory, each of these has its own independent board. Well, as a matter of law, they have an independent board. They might still be wholly owned, and the board members of this company might be appointed by the board members of this company, who in turn might be appointed by the board members of this company. As in, when this company is formed, this company says, I want Fred to be on the board. It's always Fred. Actually, it's usually David. Did you know that there are more people called David who are ASX company directors than there are female ASX company directors? I just thought I'd point that out. So let's say David. Let's just use that. We don't have a David in the room, do we? We have a couple of Matts though. So anyway, you guys there's a few Matts in the room as well. So we have a board here, the corporate board, that reports to the shareholders. As these subsidiaries are created or purchased, as part of the purchase arrangement or the creation arrangement, the initial shareholders will need to appoint at least one director, right? Because companies need to have one director. And then at the immediate following meeting of that company, those directors will need to be approved or kicked out by the shareholder. So we end up with a board here. So this board, let's say, it has a David on its board. It might then, when it gets this new company created, it might appoint David to this board as well. There's nothing to stop David being a director of many companies. But each time, David, as I'm calling him here, will have the same fiduciary obligations to each company. So what happens, more company law refreshing here, what happens, let's say David is sole director of this wholly owned subsidiary. What does this subsidiary, anybody want to pick what the subsidiary does? Let's say it sells ice cream. That's supposed to be ice cream, by the way, just so I remember what it does. The immediate parent company sells fridges, and we'll make this Wesfarmers. David is a director here. I actually have no idea whether there's a David on this board. A director of the fridge company, a director of the ice cream company. It's summer. Ice cream's doing really well. Basically, fridge company though, it's under some pressure. There's all these talking fridges that come out of China now. It's not doing as well. So it's basically saying, the board is saying, we need more cash. Okay, David, you're the sole director of this wholly owned subsidiary. We need you to declare a dividend so that all those profits you've been earning over this summer go back to this company to help us with our R&D. Can David just do that? Who does David do his duties to? Sorry? He owes, well, so in which capacity? So David, as a director of the ice cream company, he owes his duty to the subsidiary company. Is that what you're saying? Because the subsidiary company is the shareholder?
He owes his duties to each company of which he is a director of. Yes,
He owes his duties to each of these companies. So he owes to the ice cream company, he owes it to the fridge company, and he probably owes it, if he's on here as well,
if the action
to the board.
relates to the subsidiary, then he owes the duty primarily to the subsidiary who's taking the action.
So, I mean, this is a classic conflict of interest situation, potential conflict of interest, right? I mean, at the end of the day, this chain that we've drawn here, this is 100% the whole way, okay? So it's all one company. It's all part of the greater group. But at the end of the day, the directors owe the duties to each of the companies. And you can actually end up very quickly, even in a wholly owned group, in an untenable situation. Because the best thing that David can do for this subsidiary is get cash in. But that, in fact, this is a seasonal business, and it may be that if he takes the cash out of that business now, he risks, historically, that he risks that they will not be profitable or not be able to pay their debts as and when they fall due in 6 months' time. Might be able to do it now, but not when they go in 6 months' time. So often in these transactions, I point this out. I keep rubbing out that line that I don't want. I think it was supposed to be hidden because I'm just using Smart Art to draw it. Because a lot of the transactions that we look at involve bringing somebody into a group and changing the board, changing the relationships between the companies, we have directors' duties issues that arise all along. And it is very, very common for executives to hold multiple directorship positions. Now, sometimes this is dealt with, often it's dealt with by guarantees and indemnities that sit between the companies. Sometimes it is dealt with by separating out different entities and actually just saying, okay, we're going to keep this board independent of this board. But even so, in a wholly owned group, when you have an employee who's acting here, so let's say we appoint one of the Matts to be here instead, when we have employees who report directly for their job to the other subsidiary, it can be quite difficult to actually see how these duties flow. So it's just something we keep having to keep in mind as we move through.
Testing my memory a bit, but I think that HLH guy, Adler, was it? I think he got in trouble because he acted in the best interests of one company and not another.
Yeah. Because, and look, it can be completely untenable because often the only solution is to actually to resign from both, which often means actually you have to resign from your job. So, I mean, I think ultimately the HIH was a bigger issue than that because there was all sorts of layered issues, and ASIC prosecuted on the issues that it was most likely to win on. But
that was one of the issues.
Yeah, absolutely. Last time around, and I've got permission to share the conversation with you if you want it, but last time I was able to get one of the lawyers who worked with my company when it did its listing to come and talk to the group. And his name is John Hutchinson, and he was the company secretary of Centro when it collapsed. And they had lots of different interlocking issues there. And he speaks very freely. He came and spoke to the group last time around very freely about the conflict and the concern issues and the reporting. And ultimately, like the litigation from that, the judgments are actually really interesting, but that's largely around the insurance issues as much as anything else. And so Centro, sorry, let me go back again, and I'm going to test my memory for exactly what happened. But Centro is a large property group. It's now got a completely different name, which I can never remember. Sorry? Yeah, I'm not, no, I don't think it's Vicinity. Just Google Centro. Yeah, so he's at Hall and Wilcox, English guy, But he was at Centro when it all fell over. But effectively, the issue was that the board made a decision about the way to treat some numbers in the accounts. The treatment of whether it was a long-term or a short-term repayable, effectively. And from what I remember, they effectively treated the number the same way for many years in the past, but there were some changes to the accounting standards which impacted the way that they should have reported. And effectively, like any large company, they had a lot of rolling debt. So they would basically enter into facilities that would last for, say, 3 years, and almost every year they would have a 3-year facility that was ending, that they would renegotiate and that they would roll over. So they would have this kind of continuous rolling debt that was secured against the many properties that they had, and they ran, shopping centres, right? So, they've got sort of good recurring income. But there was kind of this, a perfect storm, really. Declining retail, allegedly because of online shopping, and the GFC. And one of the main things that happened with the GFC is that providers of short-term debt started to dry up. So the availability of money to borrow dried up. So while they had classified money that they had to repay as, from memory, medium or long term, it sat in a different place in the balance sheet. In reality, their ability to refinance that wasn't taken into account. Now, whether they could have known that or not is quite unlikely. I don't know. I have no insight. I have no reason to believe that they would have known. I've also heard their chair speak. He was left on the hook substantially over time. But ultimately, they took advice. So the biggest loser in the fallout ultimately was PwC, their auditors. But what's great about hearing John is he talks through what actually happened in the meetings and how they made those decisions. But you've got lots of directors and lots of different companies with all of those competing interests. So
there was a big piece of that judgment around the level of attention they paid to their own annual reporting as well.
Yeah. So that is what the judgment is famous for, is that they were seen as being too reliant. The directors were too reliant on the advice that they got, and there were some allegations, it's a little bit messy in the judgment where they landed on it, that potentially it was either that they were not given the information that they really needed to make a decision by the executive team, or that they didn't ask for the information. They turned a blind eye to whether or not they had the information they need, which is why John's account is, from my view, quite interesting. It's not directly on point with what we're doing, but particularly a couple of the discussion questions, it might be interesting to you to have a look at it. So actually I will continue here. So we talked about this. Companies can't own shares in themselves. So straight out prohibition in the Corporations Act. But the exceptions, as Carly mentioned yesterday, buyback arrangements, which is a way that we will look at as for particularly a takeover sense for mopping up minorities and as a strategy for changing the capital constitution of a company. If there's no consideration for the shares themselves, so where you acquire an interest that isn't a legal interest, so for example where there's some sort of trust arrangement, if there is a court interest or court order, and the most common is when there's a security interest, so when a bank, for example, takes ownership or an interest in a security that is in fact itself as part of the security for a lending package. The thing I want to point out here is it would be valuable for you to have a look at what Redmond has to say in Chapter 5 around the moral hazards that directors face. because I think that it will inform your thinking about what directors need to do when it comes to the kinds of transactions that we are talking about in this subject. Let's have a look at my notes. So particularly with public companies now, we see that there is an obligation for ASX-listed companies to publish information about their corporate governance practices, what their corporate governance policies are. And I'm seeing that trickle down more and more into large privates as well, that they are documenting and they are embedding into their culture the kind of compliance and governance thinking, largely out of cases like HIH and Centro. These things often start as a butt-covering exercise, but I think often, and I'm happy to argue with you the other way, but I have seen companies really lift their culture and their game as a consequence of these kind of requirements. I think of them as a bit like stopping smoking in pubs, really. At the very beginning you think, the music industry will die, there'll be nobody where to go, pub meals are over, our life as we know it is done, but 6 months later everybody's kind of forgotten, and it's odd when you go to another place where people are actually smoking in a public place. It's like, how did this happen? So I think sometimes this kind of regulation that directs companies to report on what they are actually doing about corporate governance requires them to think about corporate governance. They don't want to report that they are looking slack. So they build things in and it becomes part of their culture. I think it is I think we are seeing a lift, but
yeah,
would you agree with that?
Absolutely. So I'm currently working for the tax office, if you haven't guessed already. And a large part of the tax office's compliance approach to public groups and large private groups is now to look at their governance arrangements to assess tax risk. So if you can look at a group and see that they've got controls in place, then possibly they're less likely to have big tax issues. So that's a lot of the work that's going on in government, not just...
Yeah. Well, I think regulators all over the place too are using it's I find it quite interesting. They're using AI now. Like, they've got a tax office has a stream of letters now. They say, well, your profession is lawyer. Lawyers who earned within your income band had average deductibles in relation to blah, blah, blah of this. You're 50% over that. Did you by any chance make a mistake? Like, it's not even an audit at this stage. And it's like, actually, you go through and you have a look and you go back and say, no, I'm pretty sure I didn't, or whoops.
Please don't penalise me.
Yeah, pretty much. Not that that's happened to anybody that I know. And it will not surprise any of you to know that it was the amount of money I spend on software. But there you go. I just believe in reimbursing developers for the hard work that they do.
Yeah, so it's going to be increasingly driven, particularly. It's something that's happened in public groups, but will be increasingly driven at private groups.
So looking at what they do, and I think, again, my experience over longer than some of you have been alive includes that often these kind of compliance things are very much box-ticking exercises. I know, like 15 years ago, acting for a fintech group, we wouldn't even call it tech anymore, but it was at the time, that was selling some functionality into one of the big banks. The big bank had recently signed up to a corporate social responsibility governance regime that incorporated some environmental factors. So that meant that all of their suppliers had to report in relation to governance on a range of things. That included their own internal corporate governance mechanisms, but also their environmental mechanisms. And it drove me insane, because we'd have this massive spreadsheet that we'd have to go through and tick off every 12 months as to whether or not there had been compliance with each of the steps. But somewhere along the way, somebody had just cut and paste different bits of the spreadsheet. So you'd go into these different tabs, and there were about sort of the first four, which were clearly very important to the bank and very much part of its culture, things around money laundering and compliance with disclosure, etc., they were fine. But once you got to the environment, everything after that, all of the benchmarks were exactly the same, even though they made absolutely no sense. I can't actually remember what it is, but something about the amount of whether you use recycled paper or not was in the cybersecurity section. And it's just every time I would ring them and say, I think you're asking me the wrong questions. And it's like, we don't care, just fill out the thing and go back. So it was very much a box ticking exercise. And shall I say that the Royal Commission recently probably has indicated that, the bank in question got pilloried in the Royal Commission. But there was, in some places it started out just as a box ticking exercise. But my view is what I've seen is that has transpired into more deep thought over the last few years. So, too many stories. So thinking about transactions, this is part of the reading that I ask you to do. Really all I want to do is point out here that there are a range of different legal, market, social forces that align together to look after the interests of managers and shareholders, employees and shareholders in organisations. And these things need to be taken into account with any of these transactions. So they come out of things like shareholder voting rights, rights of shareholders to initiate litigation, systems for reporting and verification of corporate financial information, the design of executive compensation schemes. All of these kind of things bring together a regime that is designed to align these different interests. Whether it works or not is something that I want you to be thinking about as part of the critical analysis for this course. So finally, let's bring this together to think about what this actually means for funding a business in Australia now. So before we even start, I want to remind you that there is a general prohibition. So effectively everywhere when we're looking at the regulation in this course, we start with a prohibition, a law that says you actually can't do this unless an exception applies. So if you want to issue a security, you cannot do that unless you either disclose to investors or an exemption to that requirement to disclose to investors applies. So again, at risk of kind of oversimplifying, if I go back to incorporating my robot business here, if I'm starting off as a sole practitioner, literally what I am doing is, on paper at least, I am paying money for my robot business, which I then put into a company. In exchange for that company, I issue, for that business, I issue shares. So let's think of these little post-it notes here as share certificates. I now hold shares in the capital of Robots Inc. Robots Inc. is not the robot. It is not the assets that comprise that business. It is a company. In fact, I will use the plastic bag. Some additional robots have been purchased, but none have been harmed in the creation of this company. Here we have a company. Shares have been issued. If I want to issue more shares, I am taking additional money, putting it in the bag. I can't reach, I haven't got my money on the table for some reason. Digital money. I put it in here and I issue more shares. So what it is that at the moment, if I own all of the shares, it's 100%, it's a wholly owned corporation that I 100% control. But when I want to raise more money, it might be that I'm taking money from people, investors around the table, throwing that money into the company here. Now, one of the things, again, working at the specky techie end of the market, you rarely see this as a problem at the high end, although sometimes you do need to explain it, is that there can be confusion very early on about whether you are selling shares or issuing shares. People who are not lawyers or accountants tend to use exactly the same words. You say, I bought shares. That doesn't distinguish about whether they were brand new shares that were issued to you in exchange for your cash or whether I sold them to you. Now, founders will often sell their shares. If they're not making enough money to actually pay their own bills, they're just keeping the company running, then sometimes they will sell their own shares to investors so they can pay their own bills. Often, investors in companies, when I say often, it probably is at the specky techie, unadvised end of the market, but I have seen on many occasions people who have made investments thinking that their hard-earned cash is going into the business to help its growth and development, where in fact what is happening is that the money is going to a founder to pay her mortgage, and she's, the business is staying as it is and continuing to flounder, but the founder's paid her mortgage. Where I've seen that become particularly difficult is when the company does continue on and then does an issue later, and we'll get to this when we talk about the IPO, because founders' shares are treated differently in an initial public offering from ordinary shares. Even if they are classified as ordinary shares, they are treated differently by the ASX. So let's talk about I want to focus on issues, and next time around we will talk about sales of shares, but I just want to make sure we're talking about issues. So Section 707 says that only some sales need disclosure. But before we actually look at what kind, let's actually talk about what disclosure is. So this actually comes straight from the law. So I have cut and pasted this most likely from Jade because that's my database of choice. But if you went to ComLaw or Austlii, you would find pretty much the same thing. And if you looked at a printed version, you would too. Part of what was called the CLERP reforms, the Corporate Law Economic, can't remember what the P was for, CLERP. You think they could have done a little bit more work with the acronym to make it sound a little bit sexier. But the CLERP reforms were the things that took us to the current version of what the Corporations Act is, took us from what was the Corporations Law to the Corporations Act. And part of this was a plain English drive. And I think this is a particularly good example in this part of Chapter 6. What it does is it has a number of pointer tables. So when you're trying to work through it, and it's not easy to do, but I think there is value in actually getting past that fear. And I'm not sure if it's a fear of not understanding or a fear of boredom, but I get it too, of going through and actually reading the sections and seeing how they fit together. I think there is real value to that, particularly because Chapter 6 has these little guides. So here in Section 705, it sets out a table that talks about the different kinds of disclosure documents and where you go to see other information about that. So the core disclosure document, up until we had this version of the Act, the prohibition was against issuing shares without a prospectus. So now, actually, we've got this catch-all idea of disclosure documents, and disclosure documents include prospectuses, they include short-form prospectuses. I'm going to overlap them a bit because some of the content is the same in a short form and a long form prospectus. Then again, you can have a corporate bond prospectus that is effectively a prospectus with a little add-on, which is separate to it. You can have a profile statement, an offer information statement. We would also have, including disclosure documents, this can go on and on. I've just got the ones here that are relevant to issuing shares, but you might have heard the term PDS, which is really around for issuing other kinds of financial interests, units in trusts and others. So that is a financial product disclosure statement, PDS. So that's a kind of disclosure document. Why is this important? Partly because it's on the CLOs, I have to talk about it. But I think it is important because I think it gives us a good understanding as to what's driving the policy behind the way the law works when it comes to protecting investors. So when we think about issuing shares, there are two kinds of laws or bundles of regulation that we need to think about. One is the bundle of regulation that says, how do we do that? How do I change your cash into an asset of my company and give you a share? And what does that share mean? What protections, what can I do? What do I need to do as a company to report to you as shareholders? What mechanics are involved in issuing a share? So actually, I haven't checked whether it's changed lately. There was, I know there was a move towards changing it, but it's most likely still the case that proprietary limited companies still need to have paper shares, that you can't have just an electronic share, where listed companies can't have paper shares. They must actually exist the shares need to be electronic. They need to exist on an electronic register. So there's shares and regulations that deal with the mechanics and the logistics. But the vast wealth of regulation is actually about protecting investors. So if I issue you a share, what does that mean? How do you, as a shareholder, what rights do you have that attach to that share? What rights do you have that attach to the information that you get in connection with that share, to control or be involved in the management of the company? Spoiler alert, very few. To appoint and remove directors, not really at all, but to vote at meetings, absolutely. To vote now on things like a remuneration report for listed companies, yes. To receive information, particular kinds of information. So the regime is very much about protecting investors, but in particular by giving them relevant information. So there is an underlying assumption that sits behind the law that if we give you information and we punish people who give incorrect or misleading information, that you will be protected. So think about that and we can come back to it. So what are the exceptions to the obligation to issue a disclosure document? So the first one is the most common. It's the small-scale personal offer, which is in the trade tends to be called the 2012 rule or the 22 million rule. Effectively, clause or section 7081 of the Act says that provided that there are no more than 20 shareholders in any 12-month period who subscribe for no more, in total, in aggregate, no more than $2 million, those investors do not need to be counted for working out whether or not there's a requirement to disclose. So you can you can issue shares, provided you have made a personal offer to those persons, that their aggregate investment over the last 12 months is no more than $2 million. And that is a rolling 12-month period. So if at the end of last month you had incoming investment over the last 12 months that totaled $2 million, you received it from 4 people, last month you could not issue any more shares relying on this exemption. But this month you can take as much money as you like from up to 20 more people, provided it doesn't exceed another 2 million. So last month you might have been planning to make a personal offer to get another $2 million into your business, and there would be no prohibition against that. It's probably more than 15 years ago. It's probably actually since 2001 that it changed. Prior to 2000, the prohibition was against making more than 20 offers, which actually made people who complied with this provision, and I think there were many who did not, it made it very difficult to make these offers. At the time I was in investment banking, the earlier version of the rule was in place, and we often had a problem where we would have people who did not or could not meet the sophisticated investor test, or the entity that they wanted to use to invest couldn't meet the sophisticated investor test, even though the controlling entity might have at the time, but we couldn't make an offer to that entity they wanted to use to invest because we had already made an offer to their parent entity, which was a different entity, or to 20 other people. And so it really hampered the logistics of the fundraising. And I suspect, although I must admit I almost quit my job over some issues with potential compliance with that rule in particular, and ultimately did quit it over some cowboy approaches to the rules generally. But I'm pretty sure that the industry was just ignoring the offers at that change. And I think the change to subscriber as opposed to offers made is a very good change.
Reflecting reality.
It's reflecting the reality, yeah. But some of us need to do that. Sophisticated investors. It may not surprise any of you to know that you do not need to be at all sophisticated or intelligent in order to qualify to be a sophisticated investor. You just need to have assets or to have a large income. So basically, the main test that is used is you can make offers for subscriptions to a person who holds a certificate that is not more than 6 months old, that their accountant has given them, that confirms to you that they have more than I went to sophisticated, I'm actually talking to professional investors. Professional investors don't need to be sophisticated or intelligent, they just need to be rich. So sophisticated investors, they need to be able to afford to subscribe $500,000 or more. So there's no actual sophistication attached to that. They just need to have the capacity to invest that amount of money. The amount payable by the person to whom the offer is made or previously been made adds up to that $500,000 in value, or they hold that certificate that says that they hold the amount of assets that the regulations require. So I think that's net assets of 2.5 million. That hasn't changed recently, has it? Or that they have a gross income for the last 2 financial years. The number I think is $250,000, 250,000, again, unless it's changed recently. Being ill means I haven't gone and checked the regulations in the lead up to this, and I'm being caught out by my lack of confidence. So again, sophistication and professional investing really are linked to the amount of money that you have behind you. So again, most small transactions, so mid-market transactions, particularly when we're talking about a complete change of control, completely escape the disclosure requirements. So if I am selling my business for $1 million to somebody else, so I am handing over my shares, which results ultimately in the ability to control the board and to control this company. I'm taking $1 million from you. Firstly, that's a share sale. So as lawyers, we have to turn our minds to is there disclosure required? Initially, we've thought, and I haven't filled you in here, but the workarounds to ensure that you don't just issue shares and then sell them mean that shares that are issued in contemplation of a sale will fall under the disclosure requirements. But in a standard share sale or share issue arrangement, for $1 million for 100% of control, there is no disclosure requirement. Now, I don't know about you, but if I was paying $1 million for a small business, I think I'd want to know something about it, would you? Interestingly enough, kind of the market looks after itself, because $1 million really is the purchase of a small business. It's likely to be an owner-operator business. It's likely to be something that you have chosen to buy, and so there you will negotiate the price, you will make inquiries, and you will have a share sale or a business sale agreement that will include warranties in relation to that. So it is quite likely, and the market reflects, that people who are buying businesses probably up to about the 500 million mark, this regime is not going to protect them because they're asking the questions they're interested in themselves anyway, and it's just going to add to the cost of the transactions, so the regime doesn't apply. If I'm taking $1 million from you, though, to invest in my business, again, you might want some information in relation to it. The regime says if I'm just taking $1 million from one shareholder, I don't actually have any obligation to give you a disclosure document. So there's no compliance requirement, but again, the market suggests that that would be negotiated. That's a small-scale offering. It's likely to be negotiated, unless, of course, it's friends, family, fools, and that's often where the problems arise. So if there are any questions here, because this is an area I practice in, I tend to just talk about it and don't sit beautifully on the slides. So if you have questions, just please sack them out. The other way that we end up with equity is this idea of sweat equity. So this idea that I work for nothing and then I create this company. I might actually only put $2 in there for the original shares, but then subsequently I will issue more shares to other people, which sees the value of my shares, notionally at least, go up to the same amount that other people paid cash for them. This is how Silicon Valley works, right? People start with an idea. They're all in the co-working spaces all over Melbourne. There are people who have started with an idea. They probably don't spend the $600 to $1,000 that it costs these days to incorporate a company until they know that they've got some other investor coming in. And at that stage, they'll form the company. They'll hopefully transfer everything into it that they've done, or they'll sign something that says that they won't lay claim to anything personally. They'll probably continue to work for no money, and over time they'll expect that to be reflected in the value of their shares. That does have taxation consequences. One of the issues for founders often is planning. So if we all get around the table and we think that my robot company idea is a really great idea, and we all decide that we're going to invest our time and energy into building it, we might agree, I haven't counted, but let's say there's 15 of us around the table here. Let's make it 10. I'm just cutting some of you out because I can't do maths in my head today. We might agree to take 10% each. And we'll put maybe $10 in each, or it costs $1,000 roughly to set up a company. So maybe we put $100 in to get a company, to get shares right from the beginning. But then we just work. We do the work to get it in there. A year down the track, maybe I've completely slacked off and done absolutely nothing. And Harry up there has basically carried us all. If we really think about it, he's done 90% of the work. And the rest of you have done, probably the other 9%, or 10%, and I've done absolutely nothing. My shares are worth absolutely the same amount as Harry's share. Doesn't seem fair, does it? This is the stuff that pulls apart startup companies all the time. So then, instead of doing that, they try and work out models where they can release shares as they go. Let's start now, but what we'll do is we'll reward our employees or our team by issuing them options or shares that reflect the work that they do. Now, that's great. So we're a year down the track. Harry's done 90% of the work. We've all 10% shareholders equally. The company now, because of the fabulous work Harry's got, we've got an offer for somebody to come in and buy the company. Or maybe to just buy our product and work with us for another 2 years. So we're going to have income for the next 2 years. We've got to commit to keeping the business pretty much as it is, and they want us to appoint Harry CEO and pay him in the future for the work that he's going to continue doing. That all sounds pretty good. But Harry's saying, well, I'm only going to sign on the dotted line here if you reward me for the work I've done. I want a bigger share of the pie. Okay? Sound reasonable? Sound like the sort of thing you do, Harry? Absolutely. So what are you looking for? We've got 1,000 shares on issue. So what if we give you, say, another, really when we think about it, look, I've done nothing. I'm going to get some value out of this. You guys have done, another 10% between you. Seems kind of reasonable to give him another 500 shares, doesn't it? Say our company, based on what we've got, we're looking at a value. This supplier is happy to buy us for $1 million right now. But it says, well, but otherwise we'll enter into a contract with you for 2 years and we'll look at buying you in the future too. So we've got a line in the sand valuation of $1 million. If we issue Harry 500 shares right now, that has a notional value of $500,000, or somewhere between, $300,000 and $500,000. So if we just give those shares to Harry, Harry's going to have some shares that he can't sell for 2 years, and he's going to have a tax bill on somewhere between $300,000 and $250,000, because the thing that we have given him in exchange for his hard work would be classified as income. Now, I'm not suggesting that anybody does it in that very straightforward way, but they're the kind of issues that we need to think about. And so part of founding and part of thinking about how you're going to fund a company is also about thinking about how you're going to reward and repay shareholders, and how you're going to calculate that. So one of the things we could have done at the beginning is say, okay, we're going to issue 1,000 shares, but we're going to keep 500, each of us will have 5. We'll put another 500, we'll issue them, and we'll hold them together in trust, and we'll make an employee bonus scheme of some sort. And we'll agree, we might turn them into options or something. We might agree that there is a payment plan. There are bases under the tax law where we can actually create an employee and a founder's option scheme where we can basically make sure that, he will probably still have to pay tax on what it is that he receives, but he'll be able to delay the time that he pays that tax to a time when he can actually sell the share. Because that's one of the things. And don't get me wrong, I'm all in favour of tax structuring, because I think it's a great thing when people pay tax. I just don't like seeing people go broke because they can't pay their tax because it doesn't match, the obligation to pay tax doesn't match the time that they actually receive the income. And because what happens when they go broke is they're not putting their great ideas out into the community. And secondly, we never collect that tax either, and we don't build the hospitals and the schools that we should be building. So I'm not against paying tax, but I am very much in favour of thinking about the ways that we plan the structure to ensure that we match the dates that we pay tax with the dates that we receive the income. And we match the expectations that people have of what it means to be founders of companies. So they're into the sermon, sorry about that, but it is something that happens a lot, that people are, well, I should get a bigger share, and we've actually determined what the shares are earlier on. But then if we delay formation, then it may be that actually the creation of the shares later creates an income event as well. Now, one of the discussion questions you have, I'm not going to talk about this too much. I've got some slides later on, but one of the discussion questions I've asked you to have a look about is the relatively new regime, which is the referred to as the crowdfunding or the CSF regime. So basically, this is a relatively new way of funding businesses. For businesses that have particularly physical products, it's been around for a while and it's been quite successful. So this is the idea that by pre-selling your product, that you raise the money that you need to build or complete the development of your product. So there are a couple of platforms, things like Kickstarter and Posable, that are quite popular. So, her name has just gone out of my head. There's a really good TED Talk about crowdfunding from a quite well-known pop star. It'll come to me in a minute, who basically, when her label contract finished, she basically stepped away from that and then basically went to the fans and said, I want to make another album. Will you commit to paying for this? And so by pre-selling the album and adding in things like dinner with, this pop star, it's really annoying me. I know it's not Amy Winehouse, but I've got Amy Winehouse in my brain and it's just not going. So we'll get back there. I will share it. But basically she was probably, and this is probably 8 or 9 years ago, so really quite early on in the game, and it's become quite a respected way now, particularly for artists to raise money. But there are many gadgets and small businesses that do that pre-sales model. The equity model is newer and has had varying success. So my company, Domacom, has a version of crowdfunding in a sense. So it's a platform or a mechanism for allowing groups of people to buy large value assets, so residential property in particular. Other companies that are probably, this slide's a little old, Bricks with an X is probably a better known at this stage version of that. I can't help but say I don't think it's as sophisticated, but it's certainly more popular at the moment than Domacom. But over the last 2 years, the regime has expanded to allow proprietary limited companies to use this crowdfunding mechanism to raise small amounts of money. It doesn't avoid the requirement for disclosure. Apologies for my coughing. It doesn't avoid the requirement for disclosure, but it changes the nature of the requirement and it puts in opportunities for money to be held pending particular milestones happening. So many thought it was going to change the model for funding for small companies significantly. I think, have I pulled it up here? I think I've got some numbers. No, I'm actually going to, yes I do. I've got those slides in there with a bit of detail, but I think because this is just one of the discussion questions, I think it's quite an interesting question personally. I just thought this is kind of interesting. We've had the CSF regime now for proprietary companies for a little, the CSF regime for proprietary companies since the beginning of last year, and in a broader sense for probably 2.5 years now. We're a little behind the UK market. You can see they've had a cumulative up to 2016, so before our regime even came into place properly, cumulative fundraising of £634 million. So that's well over $1 billion Aussie dollars. And $750 million US in the US by March 2015. I wasn't able to find more recent numbers than that. I believe that it's flattened out a little bit in both of those jurisdictions, so the growth has flattened, but it's still continued to grow. But in Australia, we're looking at, sorry, I thought I was going to expand that there and I didn't. Significantly smaller numbers. So this is an infographic from ASIC looking at the first year. So it's roughly, although this was released in April this year, these numbers are based on raisings that are now close to 12 months old. But we're looking at only about 7 million complete offers. Now, I haven't actually been involved in a regulated CSF offer at all. I'm seeing a few people pitching that they're advising in relation to them, but nobody I know is advised in relation to one yet. Clearly they're happening because I'm assuming this number has increased, but I'm not seeing the same popularity. So I'm interested in that as to why people haven't taken this up, particularly when we're looking at these kind of numbers. And so I thought that's kind of an interesting slant to take for that discussion question for any of you who are thinking about that as one of those. So I want to move on to another slide pack. So before I go, have we got any questions, concerns? Do you guys want to stretch your legs and open the Tim Tams or something while I do that? Because I think I'll power a bit today and see. The feedback I got yesterday was break was a bit too long. Is that?
You could do slightly short for lunch.
Yeah.
Shorter lunch.
Sure.
As long as you're able to do it, though. Because
Sorry.
you're talking all day. Well.
There is a point where I probably will need an hour for lunch, but I am happy to, if you're happy to take, to move on this, if you're happy to take a 5-minute break now and then we power through and do lunch and do an hour from wherever we end up, then I'm very happy to just work on that basis if you are. Okay? Sorry, I don't know whether that'll end up on the recording or not. I also did half my recordings last night. I'm very proud of myself. Okay, so I'll just switch packs and take 5. Do you want to come back at 5:15, a bit more than 5 minutes? Stretch your legs, think of some interesting questions.